Yeah.
So just wanted to thank Robert for being here today. We have with us Dr. Robert Stewart, who is a postdoctoral fellow here at York University. We're very pleased to have him for the Junior Scholar Colloquium this morning. Thank you, Robert, for joining us. Over to you.
Thanks. So this is based on a small paper, a short paper I had done a little while back. And the main intent of this paper was to sort of make an argument for the internal rating-based approach to credit risk appropriation of regulatory capital. Now, the paper was the third part of a much larger study, and the main motivation behind that study was to assess some of the interrelationships between capital regulation and credit extension and overall economic growth after the financial crisis. So coming out of the global financial crisis, a lot of work was done to improve capital adequacy, regulatory capital. And while there's consensus on one side of that discussion, which is more regulatory capital improves bank stability, there is quite a bit of debate on the other side as to how increases in regulatory capital might impact credit extension. And in some parts of that conversation, the issue is increases in regulatory capital might actually force banks to reduce credit extension, and or they may also seek to increase the cost of credit, making loan extension or credit more expensive. But another side of that conversation argues that improvement in capital, if capital is appropriately administered, can actually increase the stability through which capital is appropriated. So in one study, I wanted to actually look to see whether or not there was this trade-off between bank stability and economic growth through the capital adequacy extension. So on one side, again, increases in regulatory capital improves bank stability, but that might be to the detriment of credit extension and by extension, GDP growth. So in one study, I simply look at how the capital adequacy ratio, changes in the capital adequacy ratio might affect changes in GDP growth, and particularly I interacted with crisis occurrences to see what actually happens during periods of crisis. And the outcome of this particular study actually didn't show any negative effect of regulatory capital on GDP growth. In fact, there were some not too robust, but some evidence to suggest that the relationship might actually be positive. So the question is, if regulatory capital can actually improve GDP growth, then where are these conversations on negative effect on credit coming from? So in a second study, I decided to go a little bit deeper, and I gather some data on credit. And the idea here is that regulatory capital might have heterogeneous relationship between different types of credit. So the two main types, I look at your household credit, which is credit extension to mainly individuals, firm credit, which is credit to private enterprises. And then I also look at this particular metric called the credit to deposit ratio. So the way banks lend is they typically rely on their deposit to extend loans. And if this credit to deposit ratio is pretty high, then it's usually an indication that banks might be relying too much on wholesale funding, which is typically short-term funding. And this particular metric was actually a large part of the conversation coming out of the crisis, because the idea is, particularly in the mortgage sector, banks typically would borrow short-term wholesale funds, originate loans, and through the securitization process, they can sell off those mortgage portfolios, repay the household funds. However, once the market for those securitized mortgage dried up, then it became a problem, because now they have a whole bunch of short-term funds they have to actually service, and no long-term assets to actually service those funds. So this particular metric, the credit to deposit, was important. And what I wanted to see was how exactly does capital the capital adequacy ratio actually affects this particular metric, and also in turn, how does this particular metric impact on GDP growth? So I set up this second one in this panel vector autoregression, and the main piece of outcome I look at there are the impulse response functions. So I look at how a change or an impulse shock to capital adequacy affects credit extension to household, to firms, as well as on the that credit to deposit ratio. And then I also look at how a shock to those different types of credit affect GDP growth. And what I found in particular is that capital adequacy seems to have a negative effect on household credit as well as the credit to deposit ratio, which are the two dimensions of credit that are typically argued to be possibly detrimental to economic growth. Whereas I didn't see a positive or a negative impulse response on firm credit. So then the argument after this is, well, if regulatory capital can potentially constrain these two sources of credit, household credit and the credit to deposit ratio, which are considered to be sources of unstable funding or unstable sources of credit, then it's possible that capital adequacy, yes, it might restrict overall lending, but what it might also result in is a better allocation of banking funds. That meaning more funds are able to go towards less risky lending sources, and less funds go towards more risky lending sources. And I argue that in order to do this, then an important quality for our regulatory capital administration is for it to be sufficiently risk sensitive. So banks appropriate more regulatory capital towards riskier exposures and less regulatory capital towards less risky exposures. So this was the sort of the premise of this third paper, and that's just the sort of evolution that went into this third paper. Now, under Basel and Basel III specifically, there are two main approaches to determine or to appropriate regulatory capital. There's what they call the standardized approach, and then there's also the internal ratings-based approach, and this specifically is for credit risk, so not market risk, not considered market risk or operational risk. So under the standardized approach, the regulators assign specific risk weights for different types of exposures, different types of loan facilities. And under the IRB approach, there's a particular formula that regulators appoint to be used. And in that formula, the banks are allowed to calculate their own internal, use their own internal models to calculate probability of default. Now, the internal rating-based approach is also broken down into what they call the foundational internal ratings-based approach, as well as the advanced internal rating-based approach. So under the foundational IRB approach, the banks are only allowed to use their internal models to calculate their probability of defaults. Whereas for the advanced IRB approach, they're allowed to calculate both their probability of defaults as well as their loss given defaults. Now, one of the concerns that further motivated the paper was the idea or the observation that most banks seem to rely on the standardized approach, which is the approach that I consider to be less risk sensitive. And there was one particular study that surveyed several countries across the globe to see which one of those approaches they actually use, which one of those approaches the regulators actually approve for banks to use to calculate regulatory capital for credit risk. And the majority of the countries tend to rely on the standardized approach, which I suppose is not surprising. I mean, most emerging markets and certainly developing economies, their regulators might actually take the simpler approach, which is the standardized approach. However, in the Basel III, there is also what seems to be a preference for the standardized approach. And that preference comes through this capital floor that they established in Basel III. And the idea of the capital floor is to actually limit the amount of regulatory capital relief that banks can actually attain using the IRB approach. So this capital floor is supposed to be phased in over several years. When it's fully phased in, which I think is in 2027, the idea is banks that are allowed to use the IRB approach will have to calculate regulatory capital using the standardized approach as well as the IRB approach. And if they're allowed to use the IRB approach, then their regulatory capital has to be the maximum of 72.5% of the standardized approach, or the value calculated under the IRB approach. So essentially, the capital floor puts a limit on how low the amount of regulatory capital banks can actually calculate when they use the IRB approach, which gives the impression that Basel seems to have a preference for the standardized approach. And typically, the conversation or the argument that they tend to, I guess, espouse to support this is that banks that rely exclusively on the IRB approach might actually be able to finesse their internal models so they can actually calculate or receive lower regulatory capital, which seems to be a concern for our the Basel Committee. Now, where you can see how this risk sensitivity is important is this particular study that was done a while back before Basel III was even implemented. So this was done to compare how regulatory capital or the risk weights are appropriated using the standardized approach and the IRB approach. So the blue line here was how regulatory capital was calculated on the Basel I, and it was just a fixed percentage of whatever the exposure is. So regardless of the risk level of the exposure. Under Basel II, they improved what they call the granularity of the risk weights. So they tried to appropriate higher risk weights for what they would consider higher risk-related exposures. And what this paper did, or what these authors did, was they compare how the risk weights or how the regulatory capital would actually look under Basel I, as well as under Basel II standardized approach, as well as Basel II internal rate-based approach. And the idea here kind of sums up what the issue is. So under Basel I, you're seeing that regardless of what the exposure is, whether you have, in this case, the horizontal axis has the credit ratings for the exposure. The exposure here is corporate exposures. So whether you have AAA all the way up to CCC, so when you go from highly investment grade to basically junk grade, you're applying the same amount of regulatory capital, which seems unreasonable. You would expect that higher risk exposures should actually have higher levels of regulatory capital appropriated towards that. Then on the Basel II, you see somewhat of an improvement. So for the higher rated exposures, less amount of regulatory capital is appropriated. That's on the red line. So the closer you are to the AAA, the less risky is the exposure. And so the banks appropriate less regulatory capital. And as you go towards the CCC, the riskiness of the exposures are increasing, and so too does the amount of regulatory capital that's been appropriated. However, when you compare the dotted line, which is the IRB approach, you see that there is what seems to be an improvement. So again, as you go closer to the AAA, the IRB approach is further able to appropriate less regulatory capital. And as you go further to the CCC, where the risk of the exposures increase, again, the IRB actually allows the banks to appropriate higher levels of regulatory capital for those higher risk facilities. So the natural question for this is, why actually would the regulatory authorities would want to stick with the SA approach versus the IRB approach? And most of the conversation seems to just be around model governance as well as model risk. And again, as I mentioned, this idea that banks, if they're allowed to use the IRB, might be able to appropriate, finesse the model, so they actually have to use less, or they are appropriated less regulatory capital. And if we go further into some retail exposures, we see the same thing. So this table actually looks at specifically mortgage exposures. The left column looks at how mortgage exposures were assigned the risk weights that were assigned to mortgage exposures under Basel II, which again was just a single risk weighted value of 35%. And then on the Basel III, they tried to again improve the granularity by appropriating this loan to value and assigning increase in levels of risk weights as the loan to value increases. And the loan to value is just the loan on the property relative to the value of the property. And one could probably understand that as the loan to value of the property increases, then the credit risk should also likely increase. In one view, a property that has a higher loan to value might attract a higher interest rate. A higher interest rate might actually create higher burden for the borrower, which could lend itself to potential, more likely lend itself to distress. But even more so during periods of distress, a high loan to value, especially one that might be over 100%, is likely to lead to default, since the owner of that property would have what they call negative equity. So why continue to repay a facility if you have negative equity in that facility? So this is one area where you see the importance of the risk granularity, which leads to more risk sensitivity for the method that's being applied. And if we go further, then we could argue that, okay, under the IRB approach, these risk weights can be further improved. One could make the case, okay, between 30%, 60 to 80% LTV, it's still a single risk weight. But 60 to 80% LTV still seems to be a reasonable range, where at the lower end, you might want to appropriate less regulatory capital than at the upper end. So what I did in this study is I gathered some retail credit data sets, a credit card data set, a secured loan data set, a retail mortgage data set, and an unsecured loan data set. So 4 very different types of credit facilities. And the idea is to calculate regulatory capital, the risk weight, as well as the regulatory capital for each of those 4 facilities, using the standardized approach as well as the IRB approach. And I stick to using the foundational IRB approach. So all I have to do is calculate the probability of default, as opposed to both the probability of default and the loss given default. And that restriction was mostly because of the information available on the data sets. So there were enough features on the data set to be able to use a simple linear classifier to determine the probability of default, but not enough information on the data set to be able to go as far as calculating the loss given default using any available models. And these are just the calculations of the risk-weighted asset using the standardized approach. So under the standardized approach, again, it's just the risk weights that are appropriated by the regulators. And under the IRB approach, there's this K value that has to be calculated, and the regulators assign this K value that's down at the bottom of this table here. So this is the function that's used to calculate the K, which is then used to determine the risk-weighted asset on the exposure. And the 2 main components of this function are the loss given default and the probability of default. And again, for the advanced IRB approach, the banks use their own internal models to calculate the loss given default as well as the probability of default. Whereas for the foundational IRB approach, they only calculate the probability of default, and the regulators assign the loss given default depending on the type of facility. And the table to the top shows what the appropriation of the loss given default is. So for the unsecured and the secured loan, these are considered non-revolving facilities, non-mortgage, non-revolving facilities. And so if they're unsecured, meaning there's no collateral being held against these facilities, then the loss given default under the foundational IRB approach is 50%, whereas if they're secured, the loss given default will vary based on the type of collateral that's used to secure the loans, secure the facilities. And here there are 4 main ones, or 4 categories: financial, collateral, receivables, real estate, and physical assets. And those are the loss given defaults that are assigned based on those types of collateral. So in this table, depending on the type of collateral for the secured loan facility, I just appropriate the LGD value that's assigned under the Basel III appropriation here. Under the standardized approach, the values in the red box there are what are assigned again by the regulators, or in this case, the general Basel Accord. So for the non-revolving, it's 75% risk-weighted assets for the exposure. For revolving, there are two categorization, whether they're transactors or revolvers, and transactors basically are credit card users that always pay off their balance. So in a 12-month period, the specific way Basel defines it, in a 12-month period, in a trailing 12-month period, there's no outstanding balance on the credit card. And revolvers are just everybody else who are not identified as transactors. For the mortgage data set, the LTVs have their specific risk weights appropriated. So again, under the standardized approach, the risk weights are just those values there in the red box based on the loan to value. And from the data set, I can get the loan to value and just appropriate the risk weights accordingly. And then under the IRB approach, the loss given default for the foundational IRB approach is just 5% for all mortgage facilities. And then the probability of default, I calculate that based on the data set. And to calculate the probability of default, again, I just use a basic linear classifier, in this case, just a logistic regression using the features on the different data sets. I just calculate the coefficients on the function, and then I use that to, well, I separate the data into a training and a tested set. So I calculate the parameters of the logistic regression using the training data, and then on the testing set, I use that to determine the probability of default. And these were the main outcomes in this particular study here. The top table just shows actual values for the RWA and the regulatory capital. The lower table is more representative since it calculates those in terms of percentages. Larger exposures would naturally have larger RWA, all things being equal. So for the bottom table, the credit card facility, under the standardized approach, there's actually less risk-weighted assets, which then leads to less regulatory capital being appropriated for the credit cards. For the secured loans, it's the opposite. Under the standardized approach, there's more risk-weighted assets and more regulatory capital being appropriated. Similarly for the unsecured and the mortgage loan. And the interesting thing about the outcome is if you look at the regulatory capital percentages, you'll see that for credit card, secured loan, and unsecured loan, it's all the same percentage. Whereas for the IRB approach, for the credit card, it's higher. For the secured loan, it's much lower. And for the unsecured loan, a little bit lower, which is what you'd expect. I mean, in practical terms, a secured loan should actually carry less credit risk since it's collateralized. How much credit risk will depend on how much, what portion of the exposure is collateralized, or how much of the exposure is collateralized. But under the standardized approach, again, all of them would actually carry the same level of regulatory capital appropriation, which again seems to be the unreasonableness behind the standardized approach. And here I just further go into the outcomes. So here again, the bottom table, the regulatory capital appropriated under credit card, secured loans, and unsecured loans are all the same. And even under the Basel III risk weight, the standardized approach, if you look at the risk weights that Basel appropriates, it's the same for any non-revolving facility, whether it's secured or unsecured, and also the same for the revolvers, which essentially is why for the standardized approach, you would see the same amount of regulatory capital being appropriated. But then if you look at the minimum probabilities that Basel actually requires for those same facilities, they're actually very different. And even the unsecured, even the loss given default appropriated for unsecured exposure, they're also different. So for example, for a revolving facility, the minimum probability is 10%, and the loss given default appropriated is 50%. Whereas for a non-revolving facility, the minimum probability is much lower, and the loss given default is also much lower. But yet still under the standardized approach, they appropriate the same amount of risk weights for the exposure. I even go further and I argue that in the case of a financial collateral, in which case the loss given default would be zero, then the amount of risk weights that that exposure would require would be zero. So the amount of regulatory capital that the bank would actually have to hold against a facility that is collateralized by financial collateral would be zero. But if the bank uses the standardized approach, then the risk weight would be 75%, which is a drastic difference in the amount of regulatory capital that the bank would hold if they choose to use the IRB versus the standardized approach. And well, the main reason that I would I guess conclude is because under the standardized approach, it doesn't seem to be any it doesn't seem to account for the loss given default. So the standardized approach again just appropriates a single risk weight, whereas IRB at least gives the formula has an argument for the loss given default. And if you look at the formula, then this K function is actually primarily driven by the loss given default, since that value there multiplies everything else that's in the square bracket. So regardless of what the probability of default is, really that value on K is highly dependent on the loss given default. So if the loss given default for a particular exposure is assigned zero, then the risk weight assigned to that facility would be zero. So I go a little bit further. And I argue that even in just this particular case, the standardized approach appears to be highly suboptimal, particularly when you consider the capital floor that's going to be phased in. So if we take the case of, let's say, a non-revolving facility where the risk weight assigned is 75% under the standardized approach, and we compare that to, let's say, the minimum amount of risk weight that can be assigned under the IRB approach, then in that case, it's going to be 6% as opposed to 8%, that being the 8% minimum capital adequacy ratio times the 75% for the risk weight. But if we consider the capital floor of 72.5% and we apply that to that 75% risk weight, then the minimum risk weight that the bank can actually derive using the IRB approach is 54%. So even if you have a collateral that is financial, where under the IRB approach, you would actually have zero LGD, which would lead to zero risk weight. The bank, once set the capital floor or the output floor is phased in, can only go as low as 54%, which again is a very drastic difference to have zero regulatory capital appropriated versus 54% risk-weighted assets. So I guess the main idea here is that the output floor, just like the standardized approach, completely disregards the loss given default. And if Basel is saying under the foundational IRB approach that you can actually derive a zero risk weight from an asset that's collateralized a particular way, then it's rather odd that under that same situation, the bank would now only be able to actually establish 54% risk weight as opposed to a 0% risk weight, which further suggests that this standardized approach is highly suboptimal. And if I take the example of the secured loans in my data set here, or in my outcome here, and I consider that under the standardized approach, the amount of risk-weighted asset that was calculated was 15 million thereabouts. Now, if I apply the capital floor to that, it means that the minimum risk-weighted asset in this situation that the lender or the bank would have been able to appropriate is 10 million. And so again, when you apply the base 8% capital adequacy ratio under the capital floor compared to the IRB without the capital floor, you go from having to hold 360,000 in this case for this particular portfolio, 360,000 in regulatory capital versus 870,000, which is a little over twice as much. And the argument there here, well, in this case, it's relatively small portfolio, 20 million. But as that portfolio increases, you can see how the amount of capital that would be required between the new approach using the output floor as well as the previous versus the previous approach where the output floor was not being administered. That can actually be quite significant. And the argument is, well, now a bank is restricted, whereas ordinarily that's capital that could have been used or could have been allocated elsewhere. More importantly, the argument can further be made that under this situation, does it disincentivize the bank to actually extend loans to secured facilities? And the argument there is secured facilities typically carry less interest rates, all things being equal, whereas unsecured facilities, the bank can actually earn more with higher interest rates. So if the bank is going to be restricted by the amount of regulatory capital it has to hold by extending facilities, secured facilities, then would it lead to some sort of perversive outcome where banks might prefer to consider unsecured facilities over secured facilities? And that's one, I guess, takeaway, one central takeaway from this comparison, that somehow it appears that the output floor has the ability to disincentivize the attraction of secured lending. Now, in terms of what could be done to address that particular potentially perversive outcome, I argue again that since the output floor doesn't seem to directly account for the loss given default, then a simple adjustment could either be one of these two things. In the first scenario, it's simply just to multiply the output floor by the loss given default. So when this is applied to the risk-weighted assets under the standardized approach, at least the attractiveness of collateral lending will still be maintained even under the output floor. Second scenario would be to just strictly consider collaterals that provide zero loss given default. And in that case, you simply assign an output floor of zero if the loss given default would have been zero, and then just maintain the capital floor structure, the output floor structure as it's presently constructed if the loss given default is not zero. And this, well, I contend would go some ways to addressing this potential perversive trait that the output floor seems to engender. Right, so in concluding, the argument here is that greater risk sensitivity as it is applied to regulatory capital appropriation might be it does appear to be superior, but there is this concern that there's a demand for more complicated models. However, if there's a lack of risk sensitivity, then this could potentially engender more or higher risk taken. And the argument there is if you have any level of risk appropriate to the same level of regulatory capital, then what would stop the bank from pursuing the highest level of risk to gain the highest level of return, given that there's no need to appropriate higher levels of capital towards those risks. Now, in Basel III, they do have both the risk-weighted capital or risk-sensitive capital, which is calculated through the RWA appropriation. And then there's also what they call this leverage ratio, which is a non-risk-based capital. And the leverage ratio is simply just a fixed percentage of the total exposure. And I think the current value is 3%. So banks have to maintain both a non-risk based capital component as well as a risk-sensitive capital component. The argument here is whether or not the standardized approach is sufficient to actually provide the level of risk sensitivity that one would expect from a risk-sensitive capital appropriation method. Because the foundational IRB approach provides more effective risk discrimination based on what I've outlined there. And so the idea there is more regulatory capital can be held against riskier exposures, less regulatory capital can be held for less risky exposures. So the IRB approach seems to be superior. The standardized approach appears to be suboptimal. So again, what exactly seems to be the driving emphasis behind the I guess, the preference towards the standardized approach through Basel. Yeah, and I'll end it there and take questions if there are any.
Thank you. Any questions?
Yeah, but normally you lead the charge. Well, you lead, carry, and end the charge.
I guess why, but anyway,
It's really just us and Dirk, really. Yeah. So if Dirk has no questions, then you can ask your questions.
Who is us?
I'm saying it's just us in the room and you online.
Okay. How many people are in the room?
so I tried to be totally honest with you. I lost you all the numbers that you presented. I'm not a numbers person, sure. But you showed one of the plots of where you compare the original Basel straight line with respect, right? This one. And then you said that sort of the how you call it, the IRB is more reflective, something so the more connected to reality than say blue and red. I sort of can see why it's more connected to reality than the blue one. But how really you know that the blue, that the standard Basel two,
what is it, two approach is better than or worse than the IRB Basel II approach, because you don't really know what the true regulatory capital is. Yes, I see that sort of it makes sense to maybe give less capital to those A triple or whatever, right? But you don't really know where those curves should lie, right? Which dominates which and how to dominate. Maybe it's over optimistic to do based on what you see what I mean. You don't really know which one is better.
Well, yeah, I see what you're saying. So one of the things I had tried to do was to see if I could find data to look at banks that actually use the IRB exclusively versus banks that use a standardized approach. And during 2008, well, see, well, what was the failure rate like? So banks that use SA, standardized approach. I mean, did we see a lot of defaults or failures versus those that use the IRB? But I couldn't find effective data to look at that, because effectively what we'd like to know is, okay, the banks that use exclusively the IRB, are they less prone to default versus those that use the standardized approach? So empirically, I couldn't, I guess, get data on that. But the idea is, theoretically, the IRB approach is supposed to be able to more, I guess, more effectively determine what the credit risk is for a particular exposure, because you calculate the actual probability of default. You still use models and data, but you're actually calculating a probability of default for that particular exposure, as opposed to the standardized approach for Basel II, where they just appropriate a risk weight. Now, how they come to the risk weight, I'm not quite sure. But I presume if they appropriate a single risk weight for a bunch of different exposures, let's say AAA, A+, and AA, then there's probably some consistency in their probability of default and loss given default. But that might not be the case. Because loss given default and a probability of default, one might expect to be different, even for three closely related credit risks once they're different. So AA, AAA, and A+. You might think, well, you presume that probability of default is different for all three, which it should be since they're rated differently, and the loss given default would also be different. So if you have a model that actually uses the actual probability of default and the loss given default, then you should have a more closer to reality representation of what the credit risk should actually be and how much capital you should appropriate towards it. I guess that's the argument theoretically.
Yeah, for the loss given default, this is my another question. But here, what I was thinking when you were talking is a very simple experiment which I would assume someone has already done. So yes, we don't have data for the defaults. This is very natural, right? So it's very hard to really see which curve is closer to the reality. But however, what we could do is assume certain assumptions. So let's say you have a portfolio of 4 exposures. I don't remember what exactly your table was saying.
Right.
You assume, let's say, that exposure A has a certain distribution, right? And this is something that you can actually, those assumptions can be quite realistic because for this you do have data.
Right.
For the defaults, it's of course the data is very scarce, but for really the exposure themselves, you have probabilistic assumptions, I'm pretty sure, right? And then exposure B is whatever, blah, 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 right? And then you have this universe that you now created. You can compute the regulatory capital based on whatever assumptions you assumed and taken the measure that you want to use. Again, I don't know value at risk or expected short or whatever measure, right?
This will be precise.
This will be precise,
In the context
right?
of this
In the
experiment.
context of this
And
experiment.
then you go
And compute your blue, red, and black line,
and
right?
then you see what.
And then you see what it means,
I
right?
see.
So this can be an experiment that is not difficult to do at all, right? In fact, you can even do pretty, I mean, you can use some recent developments in numerical analysis and probability to do the aggregate risk. For example, you have exposure A, B, and C, D. They're totally differently distributed with weights. Under certain assumptions, you can compute very well the aggregate risk, so the random variable that represents the aggregate risk, and do the measurement. Say, for example, expected shortfall is generated is equal to blah blah blah, right? And then curve do the curves. What do you think? Have you seen this being done?
I haven't seen it. I guess to make sure I understand what you're saying. So you use some theoretical model to determine what the I guess the credit risk or the unexpected loss would be for a particular type of exposure.
Mhm.
And then you use the Basel formula to calculate how much capital is appropriated, and then you see how they compare.
You're correct. Because then in my universe, I know exactly what the regulatory capital is.
Right.
For example, imagine that I use expected shortfall. I choose the confidence parameter as per what the regulator wants. The rest is, well, I just do
Yeah, it's
sort of.
actually interesting. Yeah, it does seem like it's shouldn't be difficult to do because the data, well, I mean, the model is there.
Well, there is some math in it because if you assume, say, different parametric families of probability loss for those exposures, for example, then how do you, of course, you can do those simulations, but this is wobbly. But if you want to do it properly, how do you, for example, I would assume that one of the exposures would be something like log normal, for example, right? And then what is the sum of those log normals, let's say, and log normal and Pareto, let's say. But there are ways to do it,
Yeah, yeah.
right? There are very interesting ways to do it. And then you can do, for example, expected shortfall of the aggregate. And then you can do the plots and see where the real curves
Yeah, it's
are.
actually interesting. Yeah.
So this is one thing. Another thing, this entire, again, this is sort of what I was thinking when I was listening to you. What you say is that Basel builds their analysis based on the probability of default, not on the probability of the LGD, sorry. The law given default.
Well, I'm assuming because, well, I don't know how they derive these RWAs. So these, where you see Basel III risk weight, the second column, those are the risk weights that they assign based on the exposure. Now, where they come from, I'm not sure. I don't know. But under the IRB approach, they do have a model, and I presume they probably use the same model, but they have some average representation for LGD and probability of default. So this is the model that they developed for getting the K, and the K is used to get the RWA for the IRB approach. And the loss given default is appropriated, and the probability of default is calculated under the foundational approach. For the advanced approach, this and this are both calculated by the advanced internal model, but this is the formula that they use that they present.
Oh, I see. So they let you compute the LGD.
Yeah. Under the advanced IRB approach, under the foundational IRB approach, you don't compute it, they actually assign it.
Mm-hmm.
So these are the LGD values that will be assigned based on the collateral for the type of exposure. And if it's not secured, then it's just 30%. If it's not revolving, then 50%. credit card-based facilities or other type of revolving facilities.
I understand. Because this is philosophically, this is like the discussion between the value at risk approach and the conditional tail expectation, so expected short approach, right? Because the value at risk is actually the PD,
Right.
and the expected short was like the LGD, right?
From what I understand is this is supposed to be a bottom-up approach for the let's say, excuse me, a value at risk approach. So value at risk, I see as a top-down approach. You take the distribution and you assign your alpha and then determine what your 1 minus alpha is, and that determines your threshold. And then I guess you have to just figure out like the mean and the standard deviation, and then you calculate what the bar is. Whereas as this, you actually have to go up from calculating the expected loss using probability of default times loss given default times exposure at default. And I think the way or the premise of it is you do it for normal situation and what they call downturn, and then you subtract the unexpected loss, well, the total loss from the expected loss, and that gap is what they actually use to determine how much should be appropriated for systemic or regulatory capital, which is for systemic based allocations.
And this formula, the formula that you show here for the K, this is the formula of the most recent Basel?
Yeah, this is what they use in Basel II and Basel III, so they've maintained it in Basel III.
If you could share anything written, like just to see the math behind this formula.
Yeah, I can actually share a document that describes it and does a little bit of the derivation. I think they go into the full detail, but yeah.
All right, thank you. And my last question. So this is done totally irrespective the systemic risk, I guess, right? Because this is done for every bank.
Meaning the formula that's used?
Yes.
Yeah.
So there's no systemic risk addition to the regulatory capital for a bank.
So the idea is this is supposed to determine the amount of regulatory capital for what would be considered the systemic risk portion of the portfolio. So you'd have an expected loss and an unexpected loss. And the unexpected loss is supposed to actually be how much you would expect in what they would consider the difference between your unexpected loss and the expected loss. That's what would be the amount you would hold for, I guess, a downturn, right? Because so if you appropriate your, let's say 0.99, that's the upper end of the loss distribution, and then you have your expected loss. Then what you're calculating is the difference between that upper end and the expected loss.
Yeah, but this is not the same. This is just my volatility of the market, whatever happens to me. But this is to me, my idiosyncratic volatility.
Right.
Nothing to do with the overall market.
Oh, I see what you're saying. So these R's are supposed to take into account the correlation of the asset with the market in a downturn. So that's probably the most that goes in towards attributing how the I guess the portfolio might actually change during a period of distress. Those correlation values would actually determine how much the portfolio, the behavior of the portfolio is correlated to the behavior of the market during a downturn.
I see. So those R's are like the CAPM covariance over variance. Is how it looks like the beta.
I don't think it's necessarily that, but it's there to capture correlation. But yeah, there is a formula for them as well. Yeah, that's actually in the document that I'll share. So
yeah, exactly. We can share the math.
Yeah.
Because this is okay. Thank you very much.
Okay.
But if you think that the experiment that I mentioned to you is interesting, let me know.
Yeah, actually, we'll talk about
We
it.
can
Maybe
set it up. Something.
Like me. I wish. Derek, have any questions?
Do you have any questions, Dirk? If not, I guess we can go back to Janani and wrap up.
Well, I don't really have a question as such, to be very honest, because what you do here, especially if you get into the nitty-gritty, is totally out of my ballpark, right? What I'm more curious about, because you also, when we met recently, indicated that you have an interest in corporate responsibility and similar things, right? Can you hear me properly?
Yeah, I'm hearing. Is everybody else hearing? I presume. Yeah.
Okay. The question I have, so the application of Basel, so the SA and the IRB approach, basically, is that a voluntary decision of banks
Oh no,
or rating?
it's
Go on.
yeah. So it's a requirement. So the decision whether or not a bank is allowed to use the standardized approach or the IRB is something that will be determined by the regulators. So banks can apply to use the IRB, and if the
National
regulators,
regulators.
yeah, the national banking regulators, yes.
Okay. Do rating agencies use that too? Because on
It's a
the
good question.
x-axis you have the rating. So the question is, which way does it go? Do they also, yeah, here, do they say, okay, it, it is at 4 on the y-axis, so it must be triple B plus or something like that? Do rating
Oh,
agencies use that?
I don't think so, because what the rating agencies calculate is just the probability of default typically, and then they assign a rating based on, I guess, the
Okay.
likelihood of defaulting over a particular period of time, usually within a 1 year period of time. And so the probability of default is one component of the function that's used to calculate the regulatory capital. So I
Okay,
think
so
for rating agencies, yeah, they just calculate probability of default. I don't think they would actually use these formulas, I presume.
okay. And so my question then would be, okay, so regulators, national regulators decide whether it's Basel II or Basel III, so SA or
Right.
IRB approach. Is there any
Yes.
voluntary discretion here for corporate decision making, or any dimension of corporate responsibility as in voluntary responsibility? Is there anything like that in your analysis that could feature?
If by voluntary you mean whether or not banks have the option to choose how they do calculations, they do
Yes.
have the option to choose the models that they use to calculate their probability of defaults and loss given default, but those also have to be approved by the regulators. And what will I say? What I will also say in terms of social responsibility, I have seen discussions on these same risk weights and this idea of whether or not regulators should appropriate some sort of green or sustainable dimension to risk weights. And I suppose one argument is this would actually compel banks more to lend towards those activities. But then the argument against is regulatory capital is really designed for capital buffering. It's not really designed for capital directioning. So the purpose of
Mhm.
regulatory capital is not to get banks to lend in any particular space, but wherever they choose to lend, to appropriately determine how much capital they should hold against any sort of potential systemic
Okay.
buildup.
Okay. So in some ways, in my work, I would say this is more going into what I call implicit CSR. So CSR is embedded in institutions, laws, for instance, where the regulator says you use either SA or IRB, and you use these models, and what your, I mean, post-financial crisis, I think there is a dimension for responsibility, but we don't leave you any discretion anymore. We tell you
Right.
which approach and which models to use, right?
Right. Yes.
Hmm. Interesting, interesting. Okay, that's all for now. I think we are almost out of time. So thank you very much,
Yep. Thank you.
Robert.
Thank you very much, Robert. Really appreciate your time, your participation in the colloquium. Thank you.
Thank you.